I've often said that property investment's a game of finance with some houses thrown in the middle, but currently more and more investors and homeowners are having difficulty getting finance. So what should you do? What type of finance strategy should you have to make yourself more attractive to the banks? And why are some investors able to get loans when others can't? These are some of the questions I'm going to be asking my guest today, finance strategist Hung Chuy, Director of Strategic Mortgage Brokers. And I've asked him to help you understand what's going on in the market and how to get the banks to say yes more often. So let's have a listen to what he thinks we should do.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
At our recent wealth retreat, there were many very successful property investors, but they were all keen to hear the presentation of my guest today, finance strategist Hung Chuy, Director of Strategic Mortgage Brokers. And he didn't let them down. They came away with some great insights, and that's what made me ask him to join me and you today on this podcast to give some of his insights into the finance strategies used by successful multimillionaire property investors. Hi, Hung.
Hey, Michael. Thanks for having me on.
Fantastic. Well, I know you well, and you've helped many of our clients at Metropole with finance strategies over the years, but many of our listeners won't know you. So maybe you could tell us a little bit about you, your backstory, and why we should even listen to you about finance.
I guess I've been in finance for close to 15 years. I don't think you can see me on the video today. People think I'm 12 years old based on the way I look, but I have been in the game for quite some time. We started in this country, or my family started in this country. I was born in a refugee camp, which kind of, starting with nothing or very humble beginnings led me down a path of needing to really find money or leverage in order to build my own asset base. And throughout the years, figuring it out myself, I guess, led to helping investors build their own wealth.
And you've helped a lot of people do that, which is great. So let's talk a bit about finance then, because that's critical for all investors. I know many beginning investors focus on getting the lowest interest rate, but I know strategic investors have a different focus. What should investors consider when looking to finance or refinance a property?
Yeah, so I think the key point is obviously trying to get as much equity out if they have an existing property, or it could be a strategy where they could potentially use a guarantor as the first one if they're buying the right properties, allowing them to, get into the market sooner rather than later. If they have substantial portfolios, the lenders that they do choose is very, very important that they pick a lender who's going to allow you a bit of flexibility in the long run. So not many listeners would probably realize there's a thing called portability, which is something that, allows you to, release equities when there is, release properties when there is enough equity. And there are, some banks who do it very easily and other lenders who won't allow you to release properties.
Well, that's why I like working with a finance strategist such as you, because if you go to a particular bank, they're not going to tell you that the one down the road with the yellow logo is going to give you more than the one down the road with the blue logo. Really, all they can do is sell their products. And interestingly, most people at the banks aren't even property investors anyway. So you and your team being property investors understand that. But I guess what you're saying is not all banks are created equal.
That's correct. Yeah. To highlight, I guess most of the population are with the big four banks. And, I could tell you two of the big four banks allow you to release properties at 80%. Whereas other lenders are out there, I guess the other two of the majors, they will only go back to the original loan to value ratio.
Ah. Right. So we're talking about what to focus on rather than interest rates. And I think the message is coming through that flexibility is important. What else?
Yeah, so look, valuations, not every bank is going to value your property in the same way or fashion. Some do desktop, some do electronic. Full inspection, depending on how, the data is input, will determine what your valuation will come out as. So valuers themselves are quite sensitive people. If you tell them your property is worth 1.5 million when the market data is saying 1.2 million, if you input it as 1.5 million, they often give you much lower valuation, saying you're out of your mind.
Clearly, the valuations that you get are important because the bank will lend a percentage of that valuation. And what you were saying is some send out valuers, some do desktop online valuations, which can be in your favour or work against you depending upon how your property fits in with the median. A lot of people are a bit concerned about borrowing because they see it as a risk. What finance risk management strategies do you recommend?
Yeah, so look, whenever you're buying investment properties, you always make sure you have a healthy buffer in place, whether that's in the format of pulling extra equity out for the purpose of creating that buffer, or, you're a very, savvy saver. Most of the population, they don't really budget well. And obviously with changing times, obviously inflation and everything else, people are kind of falling out of their budgets at the moment. So you got to make sure that you have enough or a healthy buffer. So if the roof breaks, there's a leak in the roof, something happens, you've got enough to carry through that and not really have to worry about a broken car and that you can't even fix.
Sure, that makes sense. So one risk management strategy that we've always recommended is having a financial buffer there too, and you can have it as redraws, as in equity and offset accounts. It's not always certain how much of a buffer you should have, and I'm not even sure we should be going down that route because everybody's got different requirements depending upon the level of their borrowings and their cash flow and the flexibility. What about fixing interest rates? That was a very good risk management strategy a number of years ago, and I'm not the right person to talk about that because usually when I do, it's gone the wrong way. But fortunately, 2.5 years ago, I did fix before interest rates went up. And having learned lessons from the past, I fixed on a very low rate for 5 years. So I'm sitting in a good position. But what's your thoughts now?
Yeah, so I think a lot of people out there, they think about fixing rates as a way to try to beat the bank. Like, is this really me trying to try to beat the bank? Like, reality is that you'll never beat the bank, right? It's just a guessing game. The reason why you would fix is to give you that peace of mind, certainty. It could be the next 2
It gave me a
years.
certainty of what my cash flow would be, Hung. That was really the aim of it.
Yeah, exactly. Well, that's the reason why you fix, right? You need to fix if for instance, for the next 2 or 3 years, you know that you've got a newborn child, or it could be a numerous amount of reasons, but it's all about certainty. So fixing at the moment, it's the fixed rates are pretty much equivalent to the variable rates at the moment. A lot of the lenders are starting to open up a few specials, which is always nice. In seeing, in some cases, the fixed rate is actually much more lower than variable rate. Again, as of probably the last 2 weeks. So you're seeing a few opportunities there to get that cash flow in place, get it to work for you based on what you forecast your budget to be. That's the whole reason to fix.
Okay, looking at other risk management strategies, I think one would be if you know your circumstances are going to change, changing jobs, business circumstances, stopping work, having a baby, getting ahead of the game and restructuring your repayments to help your cash flow would help.
Yeah, 100%. So depending on sometimes with, for instance, principal and interest repayments, people are they might have set up a mortgage a long time ago. They look at it as, I'm going to pay off my mortgage faster, and that's all great. But, meeting the minimum commitment is very important, and how long that loan is spread out / with investment properties, if you're paying interest only or principal and interest, really, when you're looking at your property portfolio, you're going to treat that as a business, right? And the most important thing in a business is cash flow, besides everything else, obviously. But, we've got to take a holistic view on the whole portfolio, including your own occupier, if you have one, and really nail that down to make sure that it's all going to be working for you.
Now, one of the thoughts is, should you just go with one lender or should you use multiple lenders? Obviously, when you start, you don't have much choice, but what happens when you get a larger portfolio?
Yeah, so as your portfolio grows, the needs of you as a client or customer, they'll keep extending and changing, right? And as that changes, it's really important, first of all, not to cross collateralize your properties, right? So that's a really, really key component.
Yes.
Never link one property to another. We've seen absolute horror stories in past times with people who've, bought in, for instance, a mining town during the last mining boom, and they had that property tied in with their owner occupier. And now they're trying to upgrade, and in order to upgrade, they need the value of that property, which has gone down 50, 60%, to be able to draw equity, which won't allow them to. So, crossing or linking properties is probably the biggest first no-no. We have a big sign in our office to say, do not cross collateralize. and we put that in, put that in the background. Using multiple lenders is also very important because if something happens, in one lender, as much as they say that they can't touch your other properties, there are instances where, they've had problems with one property and they were able to, call up shop on the whole lot.
Well, again, that's the benefit of having a strategic broker helping you put your finance together, because banks aren't going to tell you that. They're going to want to, in the little clauses in your contract, make sure that they've got the one security linked, cross-collateralized against the other. Now, there's a lot of people listening to this who are actually going to be in their own businesses. I know some banks are a bit more business owner friendly than others. How do you put yourself in a position to be more attractive to banks if you're self-employed or run a business?
Yeah, so for the self-employed customer, that's probably the type of customer that really needs a broker because, every bank has such a different appetite for self-employed, right? To give you an example, some banks will look at, company profits based on the company profits minus the actual tax rate, which is 25% currently. And they use 75% of the net income for your servicing, whereas other banks would add all of that profit back to your own name. Other lenders, they won't even touch you if you're less than a 50% shareholder in that company, or they won't use the company profits. They'll only use whatever you draw as a wage, right? So I guess overall, like if you are self-employed, it's really smart to speak to a strategic broker, somebody who understands self-employed and understands, the workings, and look at the different examples of how you structure your tax equation and how that's going to make it, I guess, easier or harder for you to get finance.
Sure. Now, at the moment, another thought is, should you go with interest only or principal and interest? Cash flow is important. How do you decide? How do you recommend to your clients to go down one route or the other?
Yeah, so look, at a high level, principal and interest is a cheaper rate of interest, whether it's investor or owner occupier. Everyone's circumstance is going to be different. We highly recommend if it's an owner occupier that you pay principal and interest because you want to pay the lowest rate of interest on your owner occupier.
Yep, because it's non-tax deductible.
Correct. As for the investment properties, you're managing cash flow. Interest only is usually quite favorable, but not in all circumstances. There are some people who may have paid off their house, for instance, and, we really want to get the best structure, best rate. Principal and interest does make sense for them because they might not be ever upgrading their house, right? But if they have the intention to upgrade at some point, then, interest only does make sense as well, as long as the rate isn't ridiculously higher, which we're looking at probably 0.25 difference nowadays.
That's not a big difference. But what do I need to understand about finance if I plan to turn my current home into an investment? I mean, for most people, they now move house every 10 years or so. The first home, even the second, isn't necessarily your forever home. So many want to keep that as an investment. The problem is if you've structured the financing correctly, it can create some challenges.
So, I think the chat around that side is a lot of people, there's an argument about redraw versus offset, which one's better. You've got these barefoot investors just pumping this weekly repayment into principal and interest repayments. All well and good if you're just trying to pay off your house. But I think if you are thinking as a smart investor and you are thinking about potentially keeping your property as an investment, you must have an offset account. So rather than paying it off through, paying the loan off directly, or, building up that redraw, the problem is if you pay down that debt facility, you'll never be able to claim the interest expense when you pull that money back out. So, key point to that is to make sure you do have an offset account. If you do, or if there is even the slightest chance that the current place that you've purchased may turn into an investment property.
In other words, you can take the funds out and the original loan's still going to be there.
Yeah, correct. Probably just to add to that is, we saw during COVID, the banks, they have control over redraw in the effect that, there were lenders out there who were actually just shutting down your redraw facility. So your access to funds were being closed off during that period just because of what was happening, I guess, in the economy. So really, really important to be using that offset.
Okay. Now, I know you've talked about the concept of effective debt recycling, a strategy that investors use. Would you like to explain a little bit about that to us?
Yeah. So what happens with a lot of investors is, they have this mindset that I'm just going to save up my 20% deposit, 10%, whatever it is, and then buy an investment property. When in fact, they build that up in the offset, for instance, and then they just go, yep, we'll put a deposit down and we'll purchase an investment property and borrow 80%. That's all well and good, but there is a much smarter strategy where effectively debt recycling means, we're going to pay off that deposit from our house, and then we're going to re-borrow that deposit so that we can effectively turn our non-deductible debt into deductible debt and claim the interest expense on 100% of the investment property, including all costs, stamp duty, buyer's agent fee if you're using a buyer's agent, and so forth.
Right. Basically, it makes your non-deductible debt on your house, the money you put in initially, the equity, now be able to use as a tax deduction, which is great. I can also see that some people would want to get into the market a bit sooner by considering using lender's mortgage insurance. In other words, not having a 20% deposit. Now, let's make it clear, lender's mortgage insurance covers the lender, not you. If you default, the insurance company will pay and they'll chase you for it. But when would you consider it's worth the cost of doing that?
If you have the opportunity to buy a good property, the longer you're going to wait for that good property, the more that property is going to go up. So eventually you're going to be priced out, right? If you have the opportunity to buy a good property and the opportunity is now, like, why not take mortgage insurance? Besides that, there are lenders out there who, can waive mortgage insurance. There is up to 95% for medico or specialists. Some lenders 85% for the everyday consumer, but there's a really special one out at the moment. There is a pilot for certain brokers which allows anybody to borrow up to 95% depending on the postcode. So if the property you are buying falls within those postcodes and I guess you tick all of the boxes, then there is the effect where you could get 95% no mortgage insurance even. But I think it's just who you talk to. If you walk straight into your bank, you're not going to understand that these options are available to you.
No, I've heard about that. So in the past, some of the banks blacklisted suburbs and wouldn't lend as much. It's almost the reverse now, that they've found some areas and some type of clients that are less risky, so they're prepared to lend them more. That makes sense. I know a lot of people at Wealth Retreat were considering getting involved in property development. I know there's lots of people listening to this who understand the concept of manufacturing capital growth, but they don't really understand how development finance is different to just standalone residential investments, the buy and hold. Do you want to just quickly go through that for us, please?
Yeah, so typically, with, I guess, development or commercial finance, if you are looking to develop and you haven't done it before, the banks look at you as a general risk, right? Because, you don't understand, there's a lot of moving parts, you don't know, there's artifacts in the ground, there's a million different things, but, and I guess Michael and myself, we've both done developments in the past, so, we have a much more sound knowledge about this. But look, generally, the general rule of thumb is 60 to 65% of LVR on development sites. And it is deemed commercial lending, right? There are smarter ways, obviously, to get around it. So, within the residential space, we can look at up to 4 dwellings as a development site, but that really depends on the site itself, the DA, and things like that are put into it.
So some loans are treated as residential at the lower rates without all the extra bells and whistles, all the other stuff you've got to go through to get a commercial loan. And that's why, in general, we recommend developing 2 townhouses or homes, which can fall under the residential lending criteria. But most people don't recognise once the development site gets bigger, there are other criteria, aren't there?
Yeah, 100%. The typical, I guess, duplex or, 2-dwelling lending is just a typical normal home loan, so nothing different.
One of the things we discussed at Wealth Retreat was commercial property, because that's a bit of a flavour of the month. There's podcasts and blogs about that and webinars telling you that you should get into commercial property. Now, I own a lot of commercial property, and I know you help a lot of clients with it. But one of the interesting things that we showed people was that finance for commercial property is so much more complicated, difficult, much lower loan-to-value ratios, that if you look at return on investment with a $500,000 deposit, for example, you may only be able to buy a $1.6 million commercial property, but possibly a $2.5 million residential property. So when you look at return on your funds as opposed to return on a $1.5 million property, it actually doesn't always make sense to buy commercial, but maybe you could just explain a little bit about how banks view commercial properties and how they finance them.
Yeah, so your typical commercial property, using a general rule of thumb, they like to lend approximately 65% loan to value ratio. It depends on the property itself as well, whether it's a standard commercial, whether it's, a very specialized commercial. There's many different forms of commercial, I guess. It really comes down to the specific property. Then, let's call your deposit 35%, which is the capital in plus the stamp duty. You've also got to consider that the lenders charge you for the valuations on every time you're going to run one. They generally charge you establishment fee of between 0.5% to 1%, and your rates are anywhere between 0.5% to 1% higher, and that's down the standard format.
Sure. The bottom line is you need more money to get into commercial property. To buy a good one, they cost more than a good residential property in general. And similarly, the banks won't lend you as much. And so therefore return on your funds aren't as good. But I know similarly, you actually do lend to a lot of commercial investors, but maybe it's best to do the sums first. Maybe the last thing I'd like to ask you is one of the concepts that a lot of people are using to get more borrowing capacities, borrowing in the self-managed super fund. Now, we're not giving any advice on this. We're not allowed to. It's a financial product. You need to get specific advice whether it's appropriate for you. But if your financial planner believes it is appropriate, how do the banks see lending for super funds?
Yeah, so typically the super fund, most of the lenders out there who are lending in the super fund, they're lending purely on your super contributions each year, plus the rental income of the property. So, take aside all of your personal liabilities, ignore that, and the super fund, it's almost like a completely separate environment, right? So what happens quite frequently is people, they really want to grow their wealth through property. They're running out of opportunities through their standard borrowing power or in their own name. So they look really taking advantage of that opportunity in their super fund rather than just leaving it in the hands of the fund managers to earn them 5, 7, 8, 9% a year. They're getting that compounding growth on an asset class like property through their super funds.
Well, again, it's a financial product, but we can't give advice on that. But as I think the benefit for many people, and it has been for me, is it actually is a different borrowing capacity. So as you say, as long as that stands alone with regard to interest coming in from the property you purchase, super contributions and other assets you got in your super fund, it's quite for many people, it's a good vehicle to grow wealth in a tax effective way. Boy, we've covered a lot in a short period of time. Clearly, I was hoping just to allow people to understand the depth of knowledge that you and your team have, and you have a significant team. But if people want to get you and your team on board, how do you help them? What do you do? Why should people come to Strategic Brokers?
Yeah, so I think at a really high level, we look at your portfolio with a different set of eyes is probably where we start off with. We have a look at exactly where you're sitting at the moment, really talk about your goals or your future goals and, what you're trying to achieve. Not like your typical broker or lender who's really just looking at the next, dangly carrot or the next property they're going to buy and how easy it's going to be for their transaction. We try to build lifetime relationships where we're ideally, you go to every time you think about money or making a money decision, so we can kind of build, that nest egg with you. So I think, on a real high level, the difference for us is that, we want to be there with you for the whole lifetime. We want to draw up a bit of a game plan to help you guys, get to the next level and help you keep building from there.
Fantastic. Well, I'll leave a link in the show notes if people want to get in contact with you. And I look forward to catching up with you again real soon to talk a bit more about finance.
Thanks, Michael. Thanks for having me. Appreciate your time.
Well, that was a fascinating chat with Hung Chuy from Strategic Brokers, and it just confirms what I've often said, that property investment's a game of finance with some houses thrown in the middle. If you want to take advantage of this current property market and get in before the crowd does when eventually interest rates fall and FOMO kicks in as more buyers get into the market, why not get a head start by having a chat with my team at Metropole? By the way, we've got no properties for sale. We're much more than another buyer's agent. We help our clients safely create intergenerational wealth through strategic property and wealth advice. And You've heard me say it before, we're big enough to tip the scales in your favour, but we're small enough to care. So, yes, there's still going to be challenges over the rest of this year. There's going to be economic, political, financial challenges, but successful strategic investors aren't really worried about where interest rates or the economy is going to be later this year, in 3 months and 6 months. They're encouraged by where our housing markets are going to be in 5 or 10 years' time. So if you're interested in getting an investment property or a new home, before FOMO drives the herd back into the market, go to metropole.com.au. I'll leave a link in the show notes and you'll be able to have a chat with one of the wealth strategists to discuss your property options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message is a continuation of the chat I had with you in the last podcast, where I shared some thoughts from Sahil Bloom, who writes a great blog called Curiosity Chronicles, and he said your entire life will change the moment you, and then he gave a whole lot of thoughts about if you stop doing certain things, good things are going to happen in your life. I went through a number of those last time, and I'm going to continue on today. And his suggestion is your entire life will change when you stop treating rest as a reward and start treating it as a critical part of your high-performance routine. Sahil Bloom said, this is one of the greatest challenges facing highly ambitious people. He said, I stopped experiencing burnout as soon as I made free time and rest a core part of my daily systems rather than reward for my efforts. I'd say much the same with sleep also. Sleep is very important. It's critical to your strong functioning during the day. Going on with the theme, your entire life will change the moment you stop tolerating people who tear you down and start spending time with people who lift you up. Bloom said one harsh truth he's learned is a person is either holding you back or pushing you forward. He said there's no in between. Your environment creates your entire reality. So he suggested you spend time with people always talking about the past, and then you're going to be stuck in it. On the other hand, if you spend time with people thinking about the big future, you're going to build a beautiful one. In that blog, he went on to say your entire life will change the moment you stop chasing things that can be bought and start prioritizing things that must be earned. He gave a quote from Ravel Ravikant saying, a fit body, a calm mind, a house full of love, these things can't be bought, they must be earned. How true. Continuing on with what's going to change your life significantly, he suggested, stop treating your body badly and start treating it like a house you'd have to live in for the next 50 years. He went on to explain that last year he asked an 80-year-old man what advice he'd give his younger self, and the response was, treat your body like a house you're going to have to live in for the next 70 years. And he said it really hit him, invest in a solid foundation daily, make the necessary repairs along the way. Okay, another thing that's going to change your life when you stop is stopping allowing constant stimulation and start embracing boredom. Sahil Bloom suggests we really need to normalise boredom. Some of our most creative moments come during periods of boredom, he suggests. In the shower, on a walk, at a dinner by yourself. You're bored, your mind wanders, your thoughts mingle, and bam! Creative insights strike. So his suggestion was schedule boredom in your weeks. Now, I know that's going to be hard for some of you, isn't it? He also suggests your entire life will change the moment you stop blaming others for your situation and start taking actions to change it. He suggests amateurs blame others, professionals are accountable. He went on to say, in the wake of failure, the amateur looks outwards. Bad luck, unfair circumstances, a cheating opponent, while the professionals look inwards. Lack of preparation, gaps in routine, uneven intensity, accountability and actions drive progress, to Sahil Bloom. And I've clearly noticed the same with investors. You've got to be the pilot of your life, not a passenger. You've got to feel like you're in control. So money doesn't care. It doesn't have a conscience. It doesn't care who owns it. You've got to now step up and don't blame the government or your education or the banks for your situation. You've got to take control. Sahil Bloom went on with this blog to say that you should stop seeking the safety of comfort and start forging yourself in the fire of discomfort. He said, do the hard things. Life's hard, but when we embrace voluntary struggle, he suggests we're better equipped for the involuntary struggle that inevitably comes. Sahil Bloom says, wake up early, get cold, move fast, lift heavy, focus, be present, have difficult conversations. He suggests that's a simple playbook to live well. Couple more thoughts in his long blog about your entire life will change the moment you change certain things. And so one of the things he suggests is stop relying on motivation and start leveraging your discipline. If you wait to act until you feel motivated, you may never start, he says. Motivation is a natural byproduct of movement. Your discipline and consistency actually create it. When in doubt, just start moving, says Sahil Bloom. He also suggests your life will change the moment you stop focusing on what you don't have and start expressing gratitude for what you do have. Now, we talk about gratitude a lot in my mindset messages, don't we? He suggests it's easy to let the shifting goalposts of your life rob you of present joy and fulfillment. You say, I'll be happy when you achieve X, but then when you do it, it just becomes 3X or 5X. So Sahil Bloom suggests you write down a point of gratitude daily to remind yourself how much your younger self would appreciate where you are today. That's something I do every day. I wake up every morning and think of 3 things I'm grateful for, but things that happened over the last 24 hours. Otherwise, it's just too easy to say the same things over and over again. 2 more suggestions from Sahil Bloom, and the one is your life's going to change totally when you stop taking everyone else's advice and start taking your own. Don't do it the right way, do it your way is what he suggests. When you start something new, everyone's going to want to give you advice on the right way to do it. They'll give you their maps for the terrain. Take their maps, but don't rely on them. Instead, use them to create your own, was his suggestion. And the last suggestion on this long list that we started in last podcast and continuing today is stop worrying about the opinion of haters and start stacking evidence to prove them wrong. He finishes off by saying, remember, you're 1 year of focus away from your haters saying you got lucky. Wow, what a list of things. Maybe I should add one more. Stop listening to this podcast because we're almost at the end of it now and start acting on one of the insights you got from it. So the life you want is on the other side of action. So pick one item from that list I read out a moment ago and earlier on last session and then go forth and conquer. Your entire life will change the moment you do. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?